subscriptions. In 2021, Kuaishou Technology, China's leading short-form video app platform, rose over 160% on the first day of listing. The stock prices of Morimatsu International Holding Company Limited and New Horizon Health Limited gained over 250 and 200% respectively on their first day. If you're an investor looking to expand your investing horizons, then the Hong Kong IPO market is the perfect opportunity for you. M+ Global would like to be the first to offer you the opportunity to invest in global IPOs. The Hong Kong market's large number of IPOs and listed companies have a global competitive advantage. In 2022, there were 84 IPOs listed on the Hong Kong Stock Exchange, raising close to 100 billion Hong Kong dollars. Many well-known internet companies, often referred to as China's Mama, comprising of Baidu, Ali, Tencent, JD.com, also collectively known as BATJ, have all been listed in Hong Kong. In addition, Asian top players in the fields of biomedicine, AI and new materials have also become highly sought-after IPOs in the Hong Kong market in recent years. Due to the market rebound and the introduction of the Hong Kong Renminbi dual counter model, the number of new stocks listed in the first half of 2023 increased about 30% compared to the first half of 2022. Top companies such as JT Express, Alibaba Cloud, and Cainiao are soon planning to be listed on the Hong Kong Exchange. These are great IPO opportunities that you can't miss. According to Deloitte, the number of Hong Kong IPOs in 2023 is predicted to surpass that of 2022 and reach 100. Plus, with the policy of prioritizing one lot per household in the allocation of Hong Kong IPO subscriptions, the average success rate for allotments exceeded 40% in 2022. With this high allotment ratio, do you feel more confident about investing in Hong Kong IPOs? Well, you're in luck. M+ Global offers an IPO financing plan. The financing leverage and quota available for each IPO may vary. Please refer to the instructions on the subscription page for details. Tap Markets to enter the IPO tab, select your desired company and the quantity you wish to subscribe to, and you can be a part of the IPO with just one click. M+ Global helps you to get on the fast track to investment. To see more videos from M+ Global, subscribe to our YouTube channel today. M+ Global, winning the world. Have you ever heard of AutoCount? It is one of the best IPO performers this year. AutoCount was listed on the Malaysian stock market in April 2023. Its stock price rose over 120% on the first day, and the IPO was oversubscribed 167 times. Malaysia has many successful IPOs, and so does Hong Kong, where you can double your wealth through IPO subscriptions. In 2021, Kuaishou Technology, China's leading short-form video app platform, rose over 160% on the first day of listing. The stock prices of Morimatsu International Holding Company Limited and New Horizon Health Limited gained over 250 and 200% respectively on their first day. If you're an investor looking to expand your investing horizons, then the Hong Kong IPO market is the perfect opportunity for you. M+ Global would like to be the first to offer you the opportunity to invest in global IPOs. The Hong Kong market's large number of IPOs and listed companies have a global competitive advantage. In 2022, there were 84 IPOs listed on the Hong Kong Stock Exchange, raising close to 100 billion Hong Kong dollars. Many well-known internet companies, often referred to as China's Mama, comprising of Baidu, Ali, Tencent, JD.com, also collectively known as BATJ, have all been listed in Hong Kong. In addition, Asian top players in the fields of biomedicine, AI and new materials have also become highly sought-after IPOs in the Hong Kong market in recent years. Due to the market rebound and the introduction of the Hong Kong Renminbi dual counter model, the number of new stocks listed
little giants. And throughout this period of time, we have been seeing a very volatile ride throughout this period, and definitely people are wondering where is the the downside of Hang Seng Index, or where are the upside of the Hang Seng Index. And we can actually understand from the past 3 trading days, Hang Seng Index has actually fallen towards the 14,900 points level. And over just 3 trading days, it has actually have a swing about 1,200 points. And today it is closing at almost near towards the 16,000 level. So this volatile ride was contributed by this 2 trillion yuan that has been putting in. China said that they want to put in more stimulus packages. So this is part and parcel of the actions that has been taken from the traders to swing from the lower point to the higher point levels. And today there are some rate cuts, bank cuts in China as well. So that has actually helped the overall market conditions to turn into a better area. So today we're very fortunate to have someone very familiar with China markets talk about this product called the China Little Giants. And we have invited Sophia Hangyu from Mirae Global Investment. She is a product and ESG specialist, and working closely with portfolio managers and the Asia Pacific research team. She also oversees the ESG initiatives of the firm, including corporate engagement and ESG related content management. So today, let's welcome her into the picture, Yeah. So hi, Sophia.
Thanks for the introduction. It's great to be here with you today.
Hello, everyone. Sorry for the delay. We have some technical glitches. Yes. If you can hear me, perhaps you can put into the chat box in our comment section just to say yes, I can hear you. Yeah. Okay. I think you can listen to my voice. Hopefully. Is it all right? Testing 1, 2, 3. All right. Okay. Great. Sorry about the delay, and really, there are so many things that we have to handle, and this is the least that we want to handle at this current live webinar. And thank you so much for joining into this unlocking the potential in the little giants. And having here with us is Sophia. And Sophia, maybe I have to reintroduce you as just a brief introduction. Sophia, Miss Sophia is product and ESG specialist in Mirae Asset Global Investment. And really, thank you so much for joining us.
Thanks for having me, Loui. It's great to be here.
Second, mute myself. And I turn on my side. Okay, Ken? Hey, Sophia, can you hear me?
Yes, I can hear you now.
Okay, I think we better go straight into the product. I mean, since that we have so many, we have delayed so much. I think just today we are going to share to the audience about what is, where are the opportunities within the China Little Giants. And I just straight away pass the ball to you, Sophia. I think we are running late, and so sorry about that. And
Sure.
maybe you can share the screen right now to maybe give us some insights on China Little Giants, because I believe that, you know,
In their fields, and they're often focusing on new technologies, products, or services in areas that are deemed critical to China's national security and development, such as semiconductors, advanced manufacturing, renewable energy, etc. Now, the Chinese government actually recognizes and supports these companies because they drive a lot of innovation. They also possess a strong capacity for research and development capabilities, and they have the potential to become future industry leaders or actually contribute significantly to the advancement of their respective fields. And as the image here suggests, these are, small to medium-sized enterprises or small to mid-cap firms, because we're looking at the listed equities only. And thus the term little giants is kind of used to differentiate these companies from the larger, more established, well-known giant corporations in China.
yeah, so I think everything starts from small, right? So I believe that they have their own technology, and they have sort of like their own very interesting growth factors as well. So why are these little giants so important? Because if I'm an investor, I would like to look for some solid growth. Why do we want to pick into little giants? Yeah.
Yeah, good question. And first of all, I'd just like to say that a lot of these little giants, even though they're little, they've actually been around for a very long time. So some of them have been operating for 10 to 15 years already. So they have, good track record of innovation already behind them. But despite their size, these little giants are actually considered to be critical to China's economic strategy. And that's why they're so important. And they're basically there to kind of support the country's move up the value chain and promote technological advancements. I think it's worth probably taking a step back to understand why that's important, why where we are now. And if you think about kind of, where we were 40 years ago, since China, went through reform and opening up, China's economy has actually experienced a very rapid period of phenomenal growth. And also since joining the World Trade Organization, China's manufacturing industry has developed really, really rapidly. So much so that by 2010, China actually surpassed the US as the largest manufacturing country in the world. But this kind of rapid growth isn't really sustainable without continuous innovation. And so the ambition to transform from, being just the largest manufacturer to actually becoming a manufacturing powerhouse is kind of what China is aiming to do now. So when we think about manufacturing powerhouses, these are, traditionally your, US companies or German or Japanese companies who have been, really world leaders within their respective fields of manufacturing. Now, from an economic perspective, I think this shift really emphasizes the move away from traditional growth model, which relied heavily on large-scale industrial manufacturing, low-cost exports, low-value-add products, to instead now focusing on fostering much more sustainable economic development characterized by high tech, high innovation, strong branding, and technological advancement. And I think the important part is that China actually recognizes that small to medium-sized enterprises are vital in this economic shift and development, because these companies are typically more nimble. They are, more specialized in large corporations, and they can adapt very quickly to, changing market conditions and adopting new technologies. Another reason why they're important is that, as we think about factors such as deglobalization, trade frictions, and geopolitical tensions, we've seen a significant fall in foreign direct investment into China, especially into manufacturing sectors. So therefore, I think this Little Giant policy was really designed to try and also help build self-reliance in advanced technologies. And it also aims to cultivate a more resilient and more competitive industrial supply chain. So with all of these kind of factors combined, I think the Little Giant program is actually a very important policy tool and framework for the government to execute.
Yeah, I believe that, with all these policies, how can they actually be chosen to become a Little Giant company? Because it's not any Tom, Dick, and Harry can actually hold this title, right? I mean, how are they being chosen?
Yeah, good question. So it actually undergoes a very, very rigorous process. So the selection process actually involves various stages of scrutiny, including kind of initial recommendations and applications, assessment by industry experts, but it's all kind of monitored by the China's MIIT, which is the Ministry of Industry and Information Technology. So in 2019, they kind of came out with this plan for the kind of specialized SME program, part of which includes these Little Giant companies. So the high-level goal set by the MIIT was to have 10,000 Little Giant companies established by 2025, selected from a pool of 1 million kind of more innovative SMEs, of which 100,000 would qualify as specialized SMEs. And then even further from that, those 10,000 Little Giants don't just stop there. There are plans for, 1,000 of those Little Giants to then become manufacturing champions for China by 2025. And in terms of kind of where we are today, as of July last year, I believe, China has actually already cultivated more than 12,000 Little Giant companies, almost 100,000 specialized SMEs, and over 200,000 innovative SMEs. So they've made significant progress on that. In terms of what the selection criteria is and how companies are actually chosen. So the selection criteria themselves are quite broad, but with fairly strict standards. Like these are held very, very highly. And they include things like having sufficient market share. So market share of your core business needs to be above more than 10% in China. Your sales growth CAGR over the last 2 years needs to be over 5%. This is to ensure that you can deliver consistent, healthy growth. Debt to asset ratio needs to be less than 70%. You need to show that you have solid financial stability and you're not overly reliant on debt. You also need to show that you've got kind of stringent R&D related spending to show that you are investing in continuous innovation. Number 5, around intellectual property rights, is much more of a tangible measure of a company's innovation output. So holding multiple first-class IP rights indicates that a company is not only innovating, but they're also protecting their innovations, which can be critical when we think about being able to monetize some of those IP later on. And then finally, this criteria around alignment with national goals is really to make sure that these Little Giant companies are aligned with China's broader industrial policy goals, and actually operates in sectors that are deemed crucial for China's economic future. So I think altogether these criteria reflect a company which has not only financial health, but also market leadership. It has strong innovation capacity and strategic alignment with national industry priorities. So we really believe that these companies that actually meet these criteria are probably likely to deliver significant upside growth potential over the coming decade.
Yeah, thanks, Sophia, for the elaborations on how they are being chosen. I guess there are it is very stringent to be selected as a little giants. I think one question right now is that what will be how will they deal with those that is not in the list? Well, how can they nurture them continuously? If they fail to go into this criteria or this list of pools of little giants, can they be nurtured in any form later stage to become the little giants going forward?
Yeah, absolutely. It's a very continuous review process. So it's not just a once off. Even though you've made it onto the Little Giants list, you still are, constantly monitored to make sure that you're meeting your metrics and targets that you've set. So companies that don't, fail to meet, on first application, they're not suddenly out of the running, but they do have opportunities to continue to strive towards that status. I think once they do get that status, though, as a Little Giant company, that affords them a lot of benefits. Which I've kind of summarized on this slide. So, some of the benefits of being a Little Giant company is that, a huge one is getting access to funding or financial incentives like tax breaks, getting favorable lending rates and grants for research and development. So for a small to medium-sized enterprise, that's actually very, very significant to be able to get that kind of financial resource, because it reduces strain on your operations and it allows you to invest more in kind of cutting edge technologies and actually your market expansion efforts. So I think once you are a Little Giant, it's a little bit easier to stay there, but you still do need to deliver on the kind of metrics and targets that have been set. Other benefits in addition to the funding, Little Giants also benefit from kind of connecting into China's industrial chain. So again, once you're there, you're really kind of brought into this ecosystem. So basically, the government has created a platform whereby companies can connect and identify supply demand for innovation needs. Essentially, what that does is it connects these SMEs to become partners for larger enterprises within China. And then finally, at the bottom of this pyramid, they also benefit from kind of longer term cultivation and development, because, this is in a way an endorsement by the government, and it really, really enhances these companies' reputation and credibility. So what this translates into is often, easy access to international and domestic markets. As a Little Giant company, you've also got stronger negotiating position when you're trying to form partnerships. And then also just fundamentally, it helps you attract and retain talent as well when you're hiring for top talent. So in essence, I think the government's support of Little Giants really extends beyond just mere financial aid, but it's really a comprehensive boost to the company's overall ecosystem.
Yeah, I guess getting funding is very important. So as you said, if they are in this Little Giants list, then they will be getting funded much easier. And but the question is, when investors wants to put their money into these kind of companies, what kind of growth factors and what kind of prospects are we having in these Little Giants? Because like I said earlier on, there might be some that has dropped out from this list, right? So if they are, if they have invested in those that are not able to sustain growth for another 10 to 15 years, then what sort of growth prospects can we anticipate from all these pools of Little Giants?
Yeah, so firstly, I'd probably just touch on the fact that as investors, if you're looking to invest into this theme, it's probably quite difficult to invest in specific companies themselves. One, because there's so many of them. I just mentioned there are 12,000 Little Giants already. Two, not all of them are listed. And then three, they're often operating in such niche markets that it's quite difficult, unless you're a specialist in that market, to actually do analysis on them. So while we're not talking about specific products here today, I think a good way of approaching this theme is to actually look at a broad basket, say within an ETF. That's a good way of kind of investing in this theme. And then that way, you're not, in an ETF product, that would automatically rebalance. So if companies do drop off the list or they make it onto the list, that's automatically rebalanced generally on a twice yearly basis within an ETF structure. But in terms of kind of the longer term drivers of this theme from an investor point of view, just before I touch on this slide, I do want to mention, since the launch of the Little Giant program in 2019, I think the market's focus on this theme has increased significantly. So I think the more attention that this theme gets, the more we'll get in terms of fund flows from capital markets. But now if we actually step away from the little giant theme itself, I want to actually look more broadly at empirical analysis and point out that, you know, something that we've noticed across the board is that small and mid-cap indices actually offer superior returns in the long run. And that's exactly what little giant companies represent. They operate in that small and mid-cap space. So this chart here shows that since their inception, small to mid-cap indices globally have generally demonstrated a tendency to outperform their large-cap counterparts. Now, there are probably only two markets where this hasn't been true, and that's Australia and Asia ex Japan, and I'll come back to the reasons for those later. But in terms of this trend of small to mid-caps outperforming large caps, I think this really underscores the dynamic nature and growth potential of smaller companies. They benefit from greater agility. They're more focused in terms of their business approach, and they have just greater capacity to adapt to a quickly changing market condition. Coming back to Australia and Asia ex Japan, there are probably a number of reasons why this trend hasn't played out in those markets specifically. For Australia, I think it's more just, you know, the dominance of large caps, especially around mining and financial sector names. That's driven kind of more outperformance of large cap names. And then Asia ex Japan, we've really seen kind of more the underperformance of Hong Kong, which has really dragged down the small to mid cap sector over the last few years. But outside of those two anomalies, it's, you know, generally proven that small to mid cap indices can deliver superior returns relative to large cap indices over time. And
yeah, Sophia, I just have a question because every time we are talking about returns, right? I mean, high risk, high return. So if we are seeing, you know, sort of like a higher risk in terms of the small cap or small to medium cap kind of indices, do we also expect higher risk in this segment as well?
Yeah, I think you do see a bit more volatility in this segment, especially because they are much more growth driven. And we have seen kind of a derating in growth names over the last few years. But if you kind of look at total return, they have, and over, you know, these empirical analysis that we look at is over a long period of time. So those ups and downs, those peaks and troughs do smooth out. So I think from a historical point of view, it's still quite a valid piece of data point to look at. I'll probably just point to, you know, another example in the US, which we've looked at, again, looking at historical analysis. Of course, we, you know, can't always look at historical data as a reference point for future performance, but I think it does paint a picture of where we're at today. In the US, this is a chart which shows kind of annualized returns across various asset classes since 1990. Now, the lowest returning asset class at the top is cash, obviously. Then we have bonds. Real estate comes in at 7.6%. We've got S&P 500 at 10.8%. And then the highest returning asset class was the S&P 600 small cap at 11.5%. So again, we can see that small caps as an asset class has outperformed most other asset classes, including large caps, alternatives like real estate and fixed income in the past. Now, if we kind of look at what our future prospects are for this theme, and especially around small to mid cap names, you know, there are a lot of drivers which we think will continue to support this outperformance, not just overseas, but also in China as well. And one of these drivers is that small and medium-sized enterprises are far less exposed to global regulatory and policy risks. So as we can see on the chart on the left-hand side, small mid-cap companies around the world, this is illustrated by the blue charts, they tend to have a higher domestic revenue exposure than their large cap counterparts do. So this reduces them to kind of those global regulatory risks. Another driving force for future growth is that small to medium-sized enterprises actually employ more employees than large cap companies do. So what that means is, you know, a majority of the population in most countries actually work for small to medium-sized companies rather than large companies. So therefore, they're more likely to be favored by policymakers because they have a much bigger impact, and therefore they're more likely to receive policy support. And the opposite is true, I think, if we think about the other end of the spectrum, where there's been a global uptick in antitrust actions against large companies to ensure, you know, fair competition. And a lot of this surge, I think, has been partly driven by the growing influence of tech giants, whose expansive control over data and market share and digital platforms has really raised concerns about consumer choice and innovation. So those headwinds for those large cap names, I think, really provides a tailwind for small to mid caps going forward.
Yeah. Okay, Sophia, I just want to go back to just now. You have mentioned that since that we reckon that the investors to buy the basket of stocks instead of selecting stocks by stocks, and we can't invest in China as well. So how is this process being selected into the basket of ETF? Is there any criteria from Mirae Asset side or Global X?
Yeah, so I won't. I can't talk about any specific product here today for compliance reasons. But in general, our ETF process, in terms of how an index is formed, in this case, say Little Giants, for example, we would start with an index of stocks. So in this case, it'll be any companies that's already on the China Giant list from the MIIT official list.
All right.
That would then go through a screening criteria. So we would screen out companies to make sure that they're of high quality, there's sufficient liquidity for trading. And then, usually the top 50 stocks by market cap would make it onto the ETF. And that would be rebalanced on a, period of, I think it's every 6 months.
Right.
So anytime we see movements in market cap, we do see that reflected into the product, and that'll just balance itself out over time.
Okay, so for all these China Little Giants that is being listed in China, can we actually find those information on their financial statements on website? Is it transparent to investors?
Yeah, it is, but the only thing I'd say is that a lot of the information for these Chinese listed stocks is that they're in Chinese. So for investors, it may not be the most practical thing to, if you don't speak Chinese, to actually do your own fundamental research. And a lot of these Chinese Little Giant companies are not listed as well. So
so is this ETF also invest in those companies that is not listed?
No, it's only the listed, companies.
All right.
Okay.
Yeah. Good to understand that. So maybe you can share with us some of the examples of these Little Giants companies, perhaps the top 3. I mean, we are not giving a buy recommendation on this, just to give you some example or give some flavor to the investors out there or the audiences out there.
Yeah, of course. I think that's a really good way of illustrating what the theme is. But before we dive into some examples, just to summarize, so these companies basically distinguish themselves through several compelling characteristics. One, they command a dominant market share. These are companies which have a competitive edge through domestic substitution. That's a huge trend for them. They operate within emerging sectors with strong growth potential. And finally, they have very high ROE. So they're high growth, high returning companies. And I think this combination of factors makes Little Giant companies very unique and formidable players in the global marketplace that's poised for very sustainable success and innovation. So I'll highlight 2 examples today. One is Hangyu Microelectronics. So Hangyu operates within the semiconductor industry space as a leader in slurries. Now, what are slurries, you might ask? They're exactly what they sound like. So they're basically, muddy mixtures of solids and liquids, usually water. And in the case of semiconductor fabrication or manufacturing, slurries are used during the chemical mechanical polishing process to actually polish the wafer surface. So it's very niche. Why is Hangyu considered a Little Giant company? Well, firstly, Hangyu has a dominant market share within this slurry market, especially within China. And their products are really integral to the manufacturing process of advanced semiconductor devices. Secondly, Hangyu really benefits from kind of what I mentioned earlier around domestic substitution. So what this means is as Chinese foundries are growing, there's a growing number of Chinese foundries, they're building out their capacity. In that process, these Chinese foundries are trying to look for domestic partners or domestic suppliers as an alternative to reduce their reliance on foreign suppliers. So there's a lot of kind of tailwinds there for a company like Hangyu to benefit from. One, that they have, superior technology. They're operating in a space that is of strategic alignment with the government's initiatives. And 2, they're benefiting from that domestic substitution trend. Similarly, so for the next company, Sunresin New Materials, we see kind of similar tailwinds for Sunresin as well. So Sunresin is a leading resin-based separation and purification solutions provider in China. So what does that actually mean? Well, resins are basically solids, or like a really thick substance that can be used in a lot of different applications. Now, in the case of sun resin, their resins are unique in that they're used for separation. So think of, any process where you need to separate a specific particle, or purification. So let's say you're trying to purify a material or a liquid. Sun resin basically provides a specific type of resin that can help with those processes. So these can be applied to any process where you would need to purify or separate specific particles. So things like pharmaceuticals, food processing, environmental protection, or even processing of special metals or precious metals. So again, within this space, domestic firms in China are starting to establish a really strong foothold, and companies like Sun Resin are, benefiting from that. They've really carved out a significant market share for themselves in this niche subsector. So those are the two examples. And as you mentioned, Loui, the intention of sharing these examples isn't to promote any particular singular stock, but it's more just to give you an example of the types of companies within China's Little Giant list. And as you can tell from these two examples, they're very highly specialized in their field, very niche. A lot of people probably haven't heard of these products before. So it makes individual stock analysis very difficult. But I think that's where someone like a Global X or Mirae research team would come to provide that kind of research backing some of these investment analyses and product.
Yeah, I think it's very interesting to see all these different companies, not the conventional one that we have seen in the markets. And I think when China has this vision of China 2025 made in China kind of policy or kind of vision, where are the areas that you see has been mushrooming the most in terms of sectors? Is it the tech sector? Is it the industrial product sector? Is it the medical sector? Which sector do you see there is a lot of growth factors?
Yeah, IT has definitely been the largest sector, just because, over the last 40 years, as I mentioned, China has really developed itself into a manufacturing, stronghold in terms of kind of more low-tech manufacturing, and they're trying to shift towards more high-tech manufacturing now. And a lot of that requires IT to improve processes, to improve systems. But we're outside of IT, we also see a lot of investment into sectors such as advanced manufacturing. Again, that's kind of going with the manufacturing theme. The other area that's really critical is healthcare. So China has a aging population. With age, there's been a rise in incidence of illnesses and disease, such as diabetes, cancer rates have been going up. So finding new healthcare and biotech solutions in terms of medications, as well as healthcare services, has been very, very important agenda for China as well.
Yeah, Sophia, I just want to tap into your brain for this matter, because I felt that just like you mentioned about this aging population and also the slowdown in the population growth in China. And you mentioned also on this small little giants, China little giants, not small little giants, is actually more of their revenue are actually generated from this domestic side. So how can we envision about their growth factors going forward? Because if you're saying aging population, maybe they're not using that much of things going forward. If they are having a slow population growth, then where are the driving factors or revenue are going to be coming from?
That's a really good question. When you think about, you're right, when you think about an aging population, you're essentially taking a large part of the population out of the workforce. So is China going to still be able to produce the GDP that it's going to over the coming years? And that's a question which a lot of investors have in mind. And I think that's exactly why China is trying to push for greater innovation, because if you can drive more value out of your existing manufacturing or your, whatever you're manufacturing, whatever you're outputting, then you can demand a higher price and thereby continue to drive greater growth with less resources or less inputs or less people. In terms of the demand side, yes, consumption demand is one part of the factor. Another part of, this whole Little Giant program is actually to create companies that are competitive at a global scale. So definitely part of the equation is around growing exports as well, and that's a metric which a lot of little giant companies have, is to be globally competitive so that they can increase their share of exports.
All right. Yeah, that is a very, very good answer from Sophia. Yeah, in terms of the, we are looking at these China giants. Which index is actually tracking from the Hang Seng Index, or is it tracking the GEM or CSI 1000? What is the underlying index that we have to follow?
Yeah, so it's actually a customized index.
Okay.
So we have actually created a customized index on this, because the China little giants are basically just small, medium listed companies within China's A-share market. The other indices which you mentioned, so there are kind of comparable indices like the Hong Kong GEM, which is a growth enterprise market. That's just a broader index of small caps that's trading on Hong Kong Exchange, but they're not necessarily kind of specialized in terms of being focused on innovation. Probably the most comparable index is the Star 100 index, which is Shanghai Stock Exchange Star Market, which is also known as the Science and Technology Innovation Board. So that tracks the top 100 companies. That's much more focused on innovation. And there are, of course, some little giant companies that are on the Star market. But the index that we've created for our ETF is actually a customized index for that. I think in terms of, when we're comparing, what does the growth potential look like for a basket of China little giant companies versus some of these small mid-cap indexes, compared to Hong Kong GEM, the growth factor for a basket of China little giant companies is much higher because these are actually high growth, high quality, innovative companies. But then when you compare it to the Star 100 index, which is a little bit more comparable, I think the growth is a little bit higher on the Star 100, but also the valuation is a lot less attractive. It's a lot more expensive for Star 100 just because it's much more well known. Whereas on China little giants, you'd have a lot of companies that are not as well known. There's still a lot of price discovery opportunity there, and they're kind of still operating under the radar.
Sophia, what sort of market cap range that we can expect from all these China little giants? Because I believe that there will be a range, right?
Yeah, correct. So there's small to mid caps. So when we talk about small to mid caps, it's under 10 billion usually. So small is kind of up to 2 billion, and then mid is to 10 billion US dollars.
2 to 10 billion yuan, is that correct?
US dollars.
Oh, US dollars. Wow, that's very huge. I mean, yeah. All right.
Yeah, so I think when we think about small to mid caps in China, it's definitely slightly different relative to other countries.
Yeah, exactly. In Malaysia, we are roughly, I mean, in Malaysian term is below 2 billion ringgit market cap. So 2 to 10 US dollar, billion US dollar is quite huge in as compared to
correct.
Exactly. Okay. So I think that is more so that people can relate, how big is big or small. Actually, little giants in China is not as small. Yeah.
Exactly. No, and as I said, these are very well-established companies. On average, a lot of these companies have been operating for 15, 16 years already. So they're not startups, if you will. Okay.
Maybe I'll just pose you two more questions. I think also we can actually promote out there. If you have any questions from the audience's side, if you want to put in some questions to the chat, the comment section, please feel free to put in. We'll try to address your queries later on. But for Sophia, I think people want to know about what is the outlook for the Hong Kong stock market, because it has been quite turbulent run. What are your views? I mean, you might not need to say buy or sell, but at least you give us some can you portray us some at least some insights towards what sort of expectation that we can actually look into for the next few quarters?
Yeah, so the Hong Kong stock market itself, it's definitely been facing a losing streak. We saw the Hang Seng Index dropping for a fourth consecutive year in 2023. And, again, past performance isn't indicative of future performance, but I think we do have to recognize what those factors are that have contributed to the underperformance. And it's mostly driven by, issues that we've seen out of China. So these are, the geopolitical tensions, regulatory uncertainty, and also crisis in the property sector as well. And these issues have led to kind of the decrease in foreign capital participation that we've seen in the Hong Kong market. I think on the positive side, though, with US interest rate normalization expected this year, we could see some interest come back to emerging markets and Hong Kong. But will those flows come back to Hong Kong? I think that's the main question, especially as, this market, the tilt is much more towards the large cap Chinese names. So I think that remains a question, which really depends on China's economic recovery and geopolitical landscape. I think probably a better option for investors who are looking to invest in Hong Kong or in China is just to identify who the winners are directly in the A-share market, and then take advantage of, products such as ETFs in Hong Kong, which can give investors access to that.
Okay. Just before I go, I want to ask also on this, do they pay out dividends for these China little giants?
That I'm not sure about. I'll have to come back to you on that one.
Sure, no issues. Because I think
in general,
for Malaysian investors, I think they like dividends. So that's why if there are some dividends to entice them to sort of buy into these China the giants.
Yeah. So in general, with the ETFs, the dividends are reinvested back into the fund.
Right. Okay.
But for kind of this giant little group itself, I'm actually not sure what proportion of them actually pay dividends, because they are fairly high growth companies.
Right. Okay. Yeah, I very much appreciated the Sophia that bring us so much insights on these China giants and interpreting the opportunities within this China markets, especially small medium companies. I mean, for Malaysian investors, Inari was one of the smallest small cap companies in Malaysia as well. They have grown into top 50 in terms of market cap as well, and went into the KLCI index for once. So I think there are very much opportunities in the small medium enterprise as well. So for those that is tuning in, there is also one announcement for you all, that we are having this investment summit 2024 this Sunday. If you want to go to this event, you can actually look into this QR code, and you can also submit your application through our website, that you can actually go for this event. So thank you so much for your time, Sophia. Really appreciate that you have been sharing very good insights on China giants for us, and hope to see you again in the next product offering. Yeah.
Thanks, Loui. It's great to chat with you.
Thank you.